Let's get one thing straight. Gold and silver didn't crash because something broke in gold or silver. They crashed because the US dollar suddenly got stronger. And most people never even look at that. The real driver behind moves like this is the DXY, also called the US dollar index. So what is the DXY? It's basically a scoreboard that tracks the strength of the US dollar against a basket of major currencies like the euro, yen, British pound, Swiss franc, Canadian dollar, and others. When the DXY goes up, it means the dollar is gaining power compared to those currencies. When it goes down, it means the dollar is weakening. And now, here's the part that changes everything. Gold and silver are priced in dollars, which means they naturally move opposite the dollar most of the time. Think about it like this. If the dollar becomes stronger, then you need fewer dollars to buy the same ounce of gold. That pushes the price of gold down, not because gold lost value, but because the dollar gained value. Same thing with silver. This is why professional traders don't just stare at gold and silver charts all day. They watch the dollar first, because the dollar often moves before the metals react. If the DXY spikes, metals usually get hit, sometimes hard. And when the DXY drops, metals usually catch a strong bid and run up fast. This is where retail gets trapped. Most retail investors only watch the metal charts. They see gold pumping, silver pumping, hype gets loud, and they jump in often late. But meanwhile, institutions are watching the DXY like hawks. When they see the dollar strengthening, they know the pressure is coming. They start trimming positions, hedging, or outright selling metals before the dump hits your chart. By the time you're staring at a massive red candle, thinking what just happened, the big players already positioned themselves. And listen, this isn't some conspiracy theory. It's basic market mechanics. A stronger dollar can tighten financial conditions globally, attract capital flows into dollar assets, and reduce demand for dollar-priced commodities like metals. That creates a situation where metals can drop fast even if nothing changed about the long-term story of gold and silver. So the takeaway is simple. If you want to stop getting blindsided, you have to stop watching only the metals and start watching what controls them. Track the DXY, track interest rate expectations, track what the market thinks the Fed will do, because when the dollar catches a bid, gold and silver often pay the price. If you remember only one thing from this, the dollar is the trigger. When the DXY spikes, metals can get smashed. When the DXY rolls over, metals can explode upward. And that one relationship alone can save you from buying tops, selling bottoms, and getting wrecked in volatility. Now listen close, because this part right here is where most people completely mess up. Today's crash wasn't because gold suddenly became bad. It wasn't because silver lost value. And it definitely wasn't because the long-term story changed. Nah, this was not a fundamentals problem. This was a liquidation problem, and those two things are very different. Let me explain it simple. When markets crash fast, like really fast, straight red candles, no bounce, that usually isn't normal selling. That's forced selling, big difference. Normal selling is when someone calmly decides, okay, I'm taking profits. Forced selling is when the market says, you don't have a choice, sell now. And that's exactly what happened. See, a lot of traders don't buy metals with cash, they use leverage. Margin, futures, options, borrowed money, basically gambling with extra size. So let's say someone has $10,000, but they control $100,000 worth of silver using leverage. Sounds cool when price goes up, right? But here's the trap: if silver drops just 10%, their whole account is wiped. Gone, game over. And when that happens, brokers don't ask politely. They don't say, hey bro, you good? Nah. They auto-sell your position instantly. That's called a margin call. Now multiply that by thousands of traders at the same time. Price drops, right arrow, liquidations, hit right arrow, force selling, right arrow, price drops, more right arrow, more liquidations, right arrow, more force selling. Boom, domino effect, a straight waterfall. That's what traders call a liquidation cascade. It feeds on itself. It has nothing to do with logic, nothing to do with value. It's just mechanical selling pressure. And once it starts, it moves fast. That's why you saw $500 disappear from gold and $13 disappear from silver in like an hour. That's not investors changing their mind. That's computers smashing the sell button automatically. Now here's the crazy part most people miss. While retail was panicking, the fundamentals didn't change at all. Central banks are still buying gold. Countries are still stacking reserves. Silver still has a supply deficit. Industrial demand still exists. Nothing magically broke in 60 minutes. Only one thing changed: sentiment. Fear, that's it. Weak hands got scared and got forced out. Strong hands, they were buying your panic. Because smart money knows something. Liquidation crashes are usually temporary. They're emotional, not structural. So remember this rule: if fundamentals break, that's dangerous. If leverage breaks, that's opportunity. Today wasn't metals failing. It was over-leveraged traders getting wiped, and when leverage gets flushed out, markets reset, and that's usually when the next move starts. Now let's talk about the part nobody wants to hear: when the market is bleeding. Because when everything is red, when your portfolio looks ugly, when fear is loud, the last thing your brain says is, this might be an opportunity. But here's the truth most new investors don't understand. In bull markets, crashes don't end the move, they reset it. And history proves this over and over again. Look at what just happened a few weeks ago, end of December. Same story: fast crash, panic everywhere, liquidations triggering, people screaming it's over, social media full of doom. Gold is dead, silver topped, sell everything. You heard all that noise, and what happened next? January exploded, gold up 30%, silver up 65%, one of the biggest monthly rallies in decades, and guess what? The people who panic sold in December. They watched the whole rally from the sidelines, pain, because markets love doing one thing: they shake out weak hands before the real move starts. That's how the game works. Think about it like this: big money, institutions, hedge funds, central banks, they don't buy when price is screaming up and everyone is hyped. They buy when fear is high. They buy when retail is scared. They buy when red candles make people emotional. Because that's when prices are cheap. So what happens? Crash creates fear, right arrow retail sells, right arrow smart money accumulates, right arrow supply dries up, right arrow price rockets. Same cycle, over and over and over again, and now look at today, late January, another sharp crash. Another wave of liquidations, same fear, same panic, feels almost identical to December, right? So you gotta ask yourself, is this the end? Or is this just another reset before the next leg higher? Because here's the key thing: nothing fundamentally changed. Central banks are still buying gold like crazy. Silver still has supply shortages. Industrial demand still strong. Long-term dollar weakness still in play. So if the fundamentals didn't break, why would the bull market suddenly be over? It doesn't make sense. What changed wasn't value, it was emotion, and emotion creates opportunity. Now don't get it twisted, this doesn't mean price instantly goes up tomorrow. Markets can stay messy, they can chop, they can fake you out, but historically, sharp fear crashes inside bull markets often turn into the best entry points, not exit points. And that's the mindset shift you got to make. Instead of asking, why is it crashing? Ask, is this fear temporary or structural? Because temporary fear usually turns into powerful rebounds. So the smart move: don't panic, don't go all in either, average in, stay patient, let the weak hands get shaken out. Because if history repeats like it often does, this crash might not be the end of the story. It might be the setup for the next big run.